Thank you very much.
Okay, and we now shift to what is going to dominate January, besides, of course, pre-budget discussions, earnings season. The Q3 earnings season kick-starts with TCS on the 9th, that's Monday, and Infosys and HCL Tech on 12th, and Wipro on the 13th. The big question is, the slowdown easing, or is it worsening? And is a slowdown priced in after the 30% underperformance of these stocks last year? Rima is joining in with the key expectations. Rima.
Thanks so much for that. So let's start off by telling our viewers what we can learn and hope to learn in this quarter's results and commentary. Now, Q3 is typically a seasonally soft quarter. But this quarter, growth rates will further moderate given the higher furloughs. Remember, HCL Tech has already highlighted higher furloughs in 3 verticals: high-tech, BFSI and telecom. As you can see from the CNBC-TV18 estimates, the top 5 IT companies are expected to report a growth rate ranging from 0.5% up to 3.5%. But this is much lower than the revenue growth posted by the same companies in December of last year, where growth rates went up to more than 6%. So that's the first point. Despite December being a seasonally weak quarter, growth rates are going to slow down. But what we want to hear from the management is to understand the future demand. So in that, watch whether the furloughs will continue into Q4 as well. Secondly, how are the tech budgets? If the tech budgets are flat, and if they're not growing, and if large deals are absent, can the companies hope to see double-digit growth next year? Also, is there a moderation in the deal win outlook? What about pricing? Do you see any kind of pricing pressure? And finally, the hiring numbers, which in a way are seen by the market as a proxy for future demand. Let's move on and not talk about the margins. Now, according to the CNBC TV18 poll, margins are expected to improve for the 2nd quarter in a row. The drivers are INR depreciation and secondly, declining attrition. Now, TCS's margins are expected to rise about 70 basis points to 24.7%. For Infosys, margin expansion is seen about 30 to 40 basis points. Now, while margins are improving for the 2nd consecutive quarter, the point made by IT bears is that margins are still significantly off compared to the peak levels that the companies hit post-COVID. Remember, in the immediate aftermath of COVID, IT companies had cut back on salary costs. Travel costs were absolutely zero, and that resulted in margins surging. So the question on margins is there scope to improve margins from here on, given that attrition is on a declining trend? Or will lower growth offset any kind of margin improvement, because you need operating leverage for margins to expand from here on? Now let's move on then to the other crucial bit, and that's guidance. Now, Infosys and HCL Tech are expected to retain their revenue and their margin guidance. For HCL Tech, remember, just in the month of December, the company had tweaked its guidance. They had said that growth will be at the lower end of their guided revenue band. So don't expect any kind of change. Wipro gives you a quarterly guidance, and next quarter's guidance, that's Q4FY23, is likely to be muted, and the management could just continue to be conservative, 0 to 2%. But as we've been saying, the question really is on future demand, FY24, FY25. And here the results are unlikely to give you any strong quantitative signal on what the future outlook and growth could look like. It's too early. Perhaps we'll have to wait for April to May period. And finally, a word on the stock price on valuations. Now, the Nifty IT underperformed the markets last year. Last year, the Nifty IT index was down 25%, underperforming the Nifty by 30%, because the Nifty was up 5%. But the Nifty IT index has underperformed the markets only once in the last 15 years consecutively, which means 2 back-to-back years of a decline. So will this support a trend reversal in CY23? And finally, what about the margins? These are where the current margins, valuations of the IT companies are. Valuations have corrected, but they're still at a premium compared to the historical average levels. So will we see a valuation downgrade from here on? Will we see derating? And that's going to be a question that the street will be watching. Back to you.
Okay, thank you very much for that, Rima. Let's now invite our guest. We have Apurva Prasad, the research analyst of IT sector at HDFC Securities, joining us. Apurva, good morning. Thank you very much for joining us. When you heard Rima's presentation, what is your sense? Are furloughs going to be longer? Will it impact Q4 as well? What's your sense? Is the street still overestimating the Q3 numbers?
Well, no, so growth is certainly moderating. I mean, if you're looking at how the growth trajectory is going to be, from a peak of 18-19% that the companies did about in FY22, it comes off to 13.5% growth rate, and that comes off to about 8.5% growth for FY24. So there is that moderation. The furlough impact is higher. The context also is that the impact was not as high, last time around, which is why you had much stronger Q3. So it's to that extent it is normalizing, and which is what we're talking about. So we do see growth normalizing, and so is the case for valuation. So valuations are also trending downwards. They're off from 3 standard deviation or over 3 standard deviation, now more like 1 standard deviation. Uh, that's sort of where it stands. So the macro backdrop is obviously added to the uncertainty element. And I mean, the way you look at it, typically the businesses have about 80% visibility onto revenue and growth for next year. So that number is currently tracking a lot lower. The companies that have indicated that if typically you would have 80% visibility for the year ahead, it's running probably more like 70% visibility. So that's the level of uncertainty that one's looking at. However, despite that, if you look from what's happened on the operational side, because of this lead lag factor between growth moderation and the impact on cost of delivery, which has been normalizing, what it's going to do is the operational improvement is going to improve the profit growth trajectory. So if you look at profit growth, how that played out for FY23 and what that does in FY24, that's going to go back to double digits. So I think that's the positive thing in it.
Apurva, do you expect companies to kind of meaningfully shift when they report and then we hear the commentary, etc.? Your kind of how you'd approach these stocks, these companies. I mean, for viewers, the basic question is how should they, should they buy these stocks now? We spoke with a fund manager like S. Narain who said you should buy into this US recession, buy Indian IT services stocks as they go down systematically. So how do you expect that to change the investment approach in this space?
Prashant. So what we're saying is that we do have a constructive outlook on the sector, but what we're saying is the return expectation should be modest at best. So we expect about double-digit type of returns, and one has to have a pecking order at this. It has to be a lot more stock specific, which is what we have called out in our recent note too. So yes, I think the outlook continues to be positive, but one would have to be a lot more selective.
In what way, if you can explain, Apurva? You said you have to have a pecking order, a lot more selective. Can you explain?
Yeah, right. So if you look at the factors which is leading on to our pecking order or the preference, in our pecking order, some of the factors that we look at is the magnitude of growth. So growth leaders within the relative sub-segments, whether it is within the tier 1 or mid-tier or within some of the vertical sub-segments. That's one. Number two, the visibility of near-term delivery. That's another important factor. And wherever there are positive catalysts available. So these are some of the factors. And I think if I look at which are the companies that tick some of the boxes here, within the tier 1 IT, we do prefer Infosys. And within the mid-tier companies, we prefer Persistent Systems.
Okay. You expect margins to be better since attrition is down?
Yes, Lata, so that's happening. So like I was saying earlier, the lead lag between growth moderating and cost coming up. So take, for example, subcontracting, that number which had shot up significantly in a high demand environment, that is coming off. So the scope for that to improve exists, and you're behind that wage hike period. And so I think a lot of levers are there in the market. That's what's going to propel the profit growth. The profit growth from an FY24 standpoint is actually a lot better than FY23.
Okay. And now, you answered Prashant in detail, but are we at least towards the end of the IT down cycle?
Yeah, so I think the performance is going to be more linked to the earnings growth trajectory. If you just map out over the past year what's happened, you had valuations that have come off from over 30x to more like 21, 22x currently. And if you really look back, what's the earnings downgrade versus PE derating? It's largely been PE derating. Within the tier one pack, you've had some companies where there was a certain component of earnings cut. But if you split that with mid-tiers have actually seen earnings upgrade. And so it's really more a question of how much of the multiple is a function of the outlook for the next few quarters. And I think in that context, I think PE multiples are probably capped at one standard deviation. That's where they are, and that's what I meant by the stock performance is going to be a function of earnings growth.
Okay. Well, we will see how things happen, and we will touch base with you when those numbers come. Thank you very much, Apurva Prasad, for joining us and helping us understand what to expect from the IT companies. Quick break, and then we'll have our technical experts, Mitesh Thakkar, join us for fresh technical trades, and we'll also have Manisha join.